Welcome back. You're watching Big Deal, and we are discussing and decoding the budget, union budget, and how it impacts M&A going forward. Ashok, one space which has seen heightened amount of M&A as well as fundraising has been the digital space, the internet space, the new age companies and the startups. How do you see that developing? Because of two important reasons. One, the LTCG surcharge to some extent is moving towards parity, which has been the long-standing demand by the industry. And the second, which is not particular to budget, but we have seen a slew of IPOs already, and post-listing, they're going down below their IPO price. Now, how do these two things fit in together to define the future course of fundraising as well as M&A here and the valuations?
So, Nisha, the fundamental principles that were guiding traction of capital for these opportunities in India still remain very intact. Young entrepreneurs willing to take the risk, people with very bright ideas, high intellectual capability, and then access to capital that wants to back these ideas, because honestly, post-developments in China, India has become a very attractive destination for this capital. So the fundamental principles on the basis of which this industry has flourished in India continues to remain intact. Sure, some of the public offerings have not been as successful in terms of post-listing price and where the valuation stands today, where these companies got listed. But that's par for the course. We have to accept the fact that some of the tailwind that helped the markets to move so aggressively upwards perhaps will be missing in the next 12 months. I'm not suggesting that they will convert into headwinds, but perhaps the tailwinds will get diluted, and therefore the momentum will be perhaps a little slower. But the fundamental principles on which that capital was attracted continues to remain intact. And therefore, it's my belief that these companies and these young entrepreneurs will continue to attract large doses of capital. I actually see an interesting change coming because of these tailwinds diluting in the marketplace. I actually see these companies that have access to a lot of capital and that have been built on strong governing principles now becoming acquirers to many offline companies. Because eventually, remember, there is no such concept as online versus offline. I think eventually you will see those who have access to capital, those who have built strong businesses on good business principles, and many of these unicorns have, will become acquirers of older generation offline companies. And the combination between the two will provide what the market eventually wants: scale, ability to grow, and get sustainable, stable cash flows with proven EBITDA earnings. So I see a lot new opportunity in the acquisition of these online companies of offline assets in India, and that consolidation play out. And I think that consolidation will continue to receive huge amount of support from investors and markets. And I don't see a dearth of capital to support these acquisitions and these opportunities going forward. No doubt that reduction in capital gains tax is positive, but I really wish that government could have extended the 2-year unlisted to 3 years, but brought the tax rates down. There's no reason why an individual has to pay 40-45% on short-term capital gains if an investment through a holding company was to attract 25%. So I wish there was a little more alignment, and the short-term capital gains tax on some of these opportunities was brought down, but I'm sure at some point of time that alignment will happen.
So the government the industry has seen this move by the government to cap the LTCG surcharge at 15% as a move in the good direction, actually, Ashok. So let's hope that by the next year, probably there is some semblance of that parity between public and private market. But Amrish is back with us. Amrish, IBC. All right, we'll get back to Amrish. But Ashok, one more important aspect on the valuations, because you are a very close market watcher as well. What is a lesson from the way we have seen the IPO frenzy and where it stands currently?
Well, it goes to say the same thing that we have heard repeatedly, but we tend to forget it from time to time, which is that market moves on sentiments, market moves on liquidity, and of course, market moves on fundamentals. You take away some of these factors from time to time, you will land back to fundamentals are eventually the drivers of long-term value in any market proposition. And you know, we learned over the last few months, perhaps a couple of years, that growth is a very important driver for valuations in the market. You know, we all grew up learning that cash flows and sustainable cash flows and sustainable profitability were the sole drivers. But the one change that we have all come to accept is that growth has become a very important factor in determining future prospects of any company and its valuation. And therefore, any company that is able to demonstrate potential for growing consistently, and of course, if it can then marry profitability and sustainability of cash flows, I think that's the true winner in the marketplace. So when all these sentiments and all this easy money and benign liquidity scenario kind of is withdrawn and there is normalcy in the marketplace, we will come back to saying that the old principles of EBITDA, sustainability of cash flows, free cash flows, of course, aided and supported now by a huge growth curve.
So I'll pick on that word, sustainability of valuations, as much required at this time, and probably that sanity is coming in. But my final question to Amrish. Amrish, of course, IBC cases have driven a large part of action when it comes to M&A. Now, how do you see some of the changes which have been brought about, small but very important ones, and especially to amend the IBC to facilitate cross-border insolvency cases? How are these going to impact the IBC cases going forward?
Yeah, I think it's an important change here, a vision that the government has put when, they've talked about cross-border IBC cases to be covered, as part of the IBC framework. I think if you look at the IBC, that is one law which has helped a lot in terms of the changes. It's gone step by step. We had, the companies in India covered, and then we moved it a little further, with all the learnings that we've had, and the government has been fast to incorporate those learnings in the act. And now, to go and look at it from a cross-border perspective. But the one more important change that they've done in the tax law, which is a very good thing. Today, under the IBC Act, any government dues on the income tax side is equivalent to any unsecured creditor. So they have the same weightage. And if you have a haircut that is announced, by the authority, which is the NCLT, what used to happen is the tax officers used to challenge that, and used to go for their full demand. I think the law now requires them to accept whatever has been said by the NCLT, and that will be a big boost for the new buyers in IBC cases who are more concerned with revival of the companies, rather than fighting some case, on the tax side. And I think that would be a big relief for the new buyers. So that's a really welcome step.
Right, and reorganization, reassessment provisions, all that set to change over there, which will impact the IBC cases as well. All right, Amrish Shah as well as Ashok Wadhwa, thanks so much for joining us with your initial thoughts on how the budget is set to change the M&A game going forward. Of course, a lot more clarifications and detailing needs to be done going forward as well, and we'll keep you up to speed on that. Thanks so much for joining us on Big Deal. It's a wrap.